Welcome to Chapter 8, which you can see from the slide has to do with sources of short-term financing. Where do you get your money if you need money for the short term, which is defined as less than a year? One is trade credit. So in this case, like accounts payable is a source of funds. Short-term bank loans. It's not that common to have a bank loan that's less than a year, but it is possible. Commercial paper, which is where companies lend money to each other on a 30, 60, 90-day basis or anything less than a year. So you have trade credit from your suppliers where they probably never thought of accounts payable or accounts receivable being a loan. But what you're doing, if you're buying something from a supplier and then you don't have to pay for it for 30, 60, 90 days, then they've basically lent you money interest-free. When the schools buy books from the publishers, they typically arrive for the fall term. They typically arrive in June, maybe even May. Well, the schools don't want to pay for them and that early because they don't get their money for them until students buy them in August or September. So the publishers will give 90 or even 120 days notice or trade credit or credit terms so that the schools can collect their cash and then pay the publisher. But the publishers gain because they don't have all these books they've got stored up and have to ship them all out in 2 weeks in August. Bank loans, promissory notes, or commercial paper, which depends on the size of the company. Small businesses don't have commercial paper. Those commercial papers only for large, well-established companies with strong credit. Bankers' acceptances, which are fairly rare. It's just a letter from the bank guaranteeing the loan or that the funds are available. Again, borrowing on a foreign basis, which has become more common with international markets, and then factoring accounts receivable and inventory, so you get a loan against or a line of credit against your AR and your inventory. You can see there's a fairly straightforward formula for calculating the annualized interest rate. Simply take the monies paid, which you can deal with as, say, interest, divided by the principal, how much you borrowed, and you multiply it by the number of time periods per year. So that will turn it into an annualized rate. Because remember, these are less than 1 year time periods we're talking about. Accounts payable, you can see for the accounts payable period, simply take AP divided by COGS, or the average daily purchases. Okay, DISC is for discount, and you can see the formula. So if you have a 210 net 30, that's 2% discount within 10 days, net 30. Not a difficult formula, except you have to be careful for the fact that under the F date and D date is the 30 days. The F date is the due date at the end of the interest-free period. So in this case, it's 30 days. And the D date is the end of the discount period. So it's interest-free for 20 days, sorry. And so in the first 10 days, you can get 2% off. But if you don't pay within the first 10 days, for the next 20 days, you don't pay interest. So it's really a 20-day, not a 30-day time period. And you can see that 2%, it's not 2% per year, it's 2% for the time period indicated in the trade credit. And so that actually works out to an annualized rate of just over 37%. So if you think about it, 30 days minus 10 is 20. You divide that into 365, you get about 18. 2 times 18 is 36. So that's where the 37% comes from, which is more exact than my approximation method. So your credit position is AR minus accounts payable. If AR is greater than accounts payable, the company is a lender or a provider of funds. If accounts payable is greater than AR, then they have a source or use of funds. Demand loans could even be things like a line of credit, and it's just the interest rate plus, and usually based on prime, the interest rate goes up or down. The prime interest rate is what the bank charges its best customers, the customers who have almost zero risk of default. So you lend $2 million to somebody who has a net worth of $100 million. Even if they default, you don't worry about getting your money back. I had a customer one time years ago who purchased a car and took a loan against it, and the car was $25,000 or so, and the customer had a net worth of $1.3 million. The bank is going to be all over that. The risk of default is, even if the person does default, you're still going to get your money back. Compensating balances are something you might be familiar with, but not aware that you are familiar with them. So this can be, in a personal sense, a compensating balance might be a situation where you have a checking account and they say there's no service fees if you keep a balance of, say, $2,000 in your account. That's a compensating balance. So in this particular case, what a company will do, what a lender will do, is they'll lend you $100,000, but require you to keep, say, a $10,000 compensating balance. So you only have access to $90,000, but you pay interest on the 100. This has become less and less common over the years. It's kind of a weird way to like make the interest rate look lower, because you can only take out 90,000 because of the compensating balance of 10,000 in my example, but yet you're paying interest on 100,000. So companies are not liking that. Banks like it, but customers don't. So in your checking account, if you keep a certain amount of money in your account and you don't pay service charges, that would be a compensating balance because you're not getting interest on that money, yet you are gaining the fact that they don't charge you your service charges. So you might actually have that depending on your type of account that you have. So in order to borrow 125,000, 25,000 would be capped that you cannot access. You can actually only take out 100,000, but once again, you're paying interest, the 8% in this particular case, not on 100,000, but on 125. So you can see that it distorts things when the real interest rate is actually higher. Discounted loans are, you have to pay me $100 in a month, but today only give you 95. So it's just, that's a discounted loan. Installment loans is what I think most of you are very familiar with, the concept anyways. You borrow $10,000, you pay it off over 3 years. Here's the interest rate. Here are, say, the monthly payments. Compensating balance is what we just talked about in the previous slide, and it's not that common. It's certainly not common on a personal basis. There are times where secondary lenders will do that. A customer needs $20,000. They'll lend them 22, but the customer only gets 20, and the customer has to pay off 22,000 at 8%. So it's very difficult for the borrower, because it's kind of jacks up the interest rate. It kind of causes the interest rate to go up. You have to pay interest on 22. You have to pay back 22,000, but you only get 20. So it's like a $2,000 administration fee. Here's a summary of the formulas, which we'll go through in various examples, finding out the interest rate, the real interest rate on loans. And we'll go through several examples of this in the subsequent videos. Accounts receivable, you can use it as collateral. You can sell it to another company called factoring, and you can also use asset-based securities, as you can see, and including the sale of accounts receivable. But these all tend to be very expensive, sort of last resort. It's like a payday loan. Desperate for cash and need it now, so you're willing to pay a higher fee for that, in this case, interest. So inventory is used as collateral. It's like AR, they're just called different things. Blanket inventory, which is just overall, they don't have, it's very specific to its particular inventory item. And that's the end of chapter 8. And we'll move on to doing some calculations.